So the clock is ticking on your valuations, right? So I hope you get a chance to work on it. Not even hope, but sometime over the weekend. But I will add another couple of office hours to this weekend in case you are getting a late start, you have questions. So it'll specifically be about the valuation. So you can come in with your company and your story. And I will try to record it because maybe other people will also then, if you have a story that other people are telling as well, maybe I can answer it. Usually I don't record office hours because I have this, I'm not sure that that's kosher because some people don't like to have their questions recorded. But in this one, I'm giving you advance notice on that particular hour, I will be recording the office hour. So today I'm going to start. We were talking about storytelling. Today's class is going to be almost entirely about storytelling. So if you have, as I tell, do this class about my stories, I want you to think about your stories as we're going along. So let's start with today's with a very simple test. Now I've had analysts who, whenever I tell the storytelling part, they say, look, I don't tell stories. I just work with numbers. Very quant people. They're very proud about the fact that they don't tell stories. They just give me valuations, and I say that's not true. When you give me a valuation of a company as an Excel spreadsheet, whether you like it or not, you're telling a story. In fact, let me give you an example. Let's suppose I send you an Excel spreadsheet, and here's what you see in the spreadsheet. You see a 50% compounded annual growth rate in revenues for the next 10 years. You see margins of 20% in year 10, the target margin, that's twice as high as the industry average. You also see a cost of capital that is lower than what is typical for this particular sector. And to cap it all off, you see very little reinvestment. So that's what the Excel spreadsheet, right? All numbers. Now I'm going to ask you back out from those numbers, whether you can tell me what kind of company it is without even looking at the name of the company. Because that's what I'm going to do. When you send me a spreadsheet, I'm not going to look at the company. I'm going to look at the numbers and try to come up with the kind of company. Then I'm going to check your company. Say, is this the kind of company where you can tell the story? First, do you think the story is about a small company or a big company? And what gives it away? Because 50% compounded growth rate means you're making your revenues about 25 times larger than they are today. Which if you have $1 billion in revenues, 10 billion and 50 billion becomes more, so it's probably about a smaller company. Second, am I telling you something about the total market? No, is there some sense of clues you can use to say, the total market that this company is going after, is it stable or growing, you think? Can a company get a 50% compounded annual growth rate in a mature market? Yes, it can if it's a small company, but then it's got to cut prices usually, right? And what have I told you? I've told you the margins are going to be twice as high. That combination of assumptions means there's probably enough buffer given this market that you can grow and raise prices. Am I telling you anything about the competitive advantages of this company? Strong, weak? What do competitive advantages translate into? You can earn much more than your cost of capital, right? So if I have very little reinvestment, I'm getting these huge margins. Guess what my return on capital is going to look like by year 10? In fact, in my spreadsheets, I make it actually explicit. Your return on capital is 35%. So I'm telling a story about strong competitive advantages. What kind of business is this? A capital intense business or a capital light business? At least based on the assumption, it must be a capital light business. What gives it away? The fact that I can get this much growth with very little reinvestment. And finally, am I telling you anything about the nature of the product or service, whether it's discretionary or not? What gives a clue on that one? Yeah. The operating margin can be high, whether it's discretionary or not, depending on it. But if you have a discretionary product, remember the betas tend to be higher, your cost of capital should be higher as well. So when your cost of capital is lower than the industry average, which is what I've seen people saying, I'm telling a story about a company that has somehow found a way to sell this high margin product that's non-discretionary. Whether you like it or not, that's a story you've told me. So for some of you, I'm going to actually take your numbers, convert into a story, and then send you the story back saying, are you okay with this story for your company? If you're not, your problem is not with me. It's with yourself. What I'd like you to do from this feedback is not, because I'm not going to be able to do this for the rest of your evaluation. I'm not doing it. So for the next 50 years, don't keep sending me Excel spreadsheets. I won't be alive with the 50th year. I want you to be able to do this yourself. And what I'm doing is, I want to lay the foundations. You take your valuation, back out the story from it and ask yourself, is this the right story for my company? Now let's move on. Let's say you've told a story for your company, you've come up with a valuation. I'm going to ask you whether this story and valuation can change. And I'll throw a bunch of things at you and you tell me whether this could change your story and valuation. An earnings report comes out about a company. Could it change your story? And if so, what element of the annual report will change your story? What is an earnings report? What do people focus on in the earnings report? When you see Wall Street Journal, next day, what's the news story? That the earnings were 3 cents higher than expected. It's all on earnings per share, right? If you're an intrinsic value investor, that's not the place where your story is going to change. Why? The fact that you reported earnings 3 cents higher than expected, big deal. You played some game with accounting, you had a better than expected quarter. What could change your story? Something the company does that you did not think it could do before you saw that earnings report. That could be good or bad. No, I'll send you a link to a post I wrote about how to read earnings report from a story perspective. What are the things in an earnings report that changes your base story? Remember earlier this year, Netflix and Facebook both had very disappointing earnings. I think the prices both dropped by 20%. Whenever you see a big drop like that, the question you're asking, has the basic story for this company changed now? Because it can't be just last year's earnings that can change that. Something about your story must have changed. In the case of Facebook, what was that number that triggered this disappointment? Yeah. The fact that the number of users for the first time in Facebook's history dropped by about 500,000. It's still like 2.9 billion. Nobody's losing any sleep over that now. But the fact that, so if you're telling a story built on user growth at Facebook, that would be a huge disappointment. The only problem is, what the heck are you telling a story about user growth at Facebook with 2.9 billion people? How much more growth can there be before you hit the entire population of the world? That includes, So that struck me as kind of an overreaction, because unless that was the start of some huge drop off in user numbers. So I took a look at why they lost 500,000. I might have talked about, what was it that caused Facebook to lose 500,000 users? You think privacy laws. Hey, those have been going on for 4 years and Facebook kept growing. You know what made Facebook lose 500,000 users last quarter? It was Apple tightening privacy restrictions on its devices that caused people to take Facebook off, because it wasn't playing nicely with Apple. It takes one giant, like Godzilla versus King Kong, right? It takes one giant to bring down another giant in this case. And that's not a permanent loss. It's a loss where Facebook will clearly adjust and adapt. So to me, that reaction seemed too large, because there was nothing in that report that would lead me to reassess it. Netflix lost value as well. There, the user growth was less. To me, the thing that has always surprised me about Netflix, to me, the biggest part of the story is how do they get content spend under control? So every time I read a Netflix report, I'm saying, are they doing things that tells me that they're going to find a way to bring this down? There was nothing in that report that led me to reassess it. They're trying, it's getting to be a lower percentage. The user growth has dropped off, but maybe this is the market catching up, saying they can't keep doing this. Why it took them so long, I don't know. But maybe people were just unrealistic about how much you can keep growing users. And maybe that engine is starting to run slower. Yep. What about it? It's the only place to go for growth, right? The US is pretty much saturated. How many Canadians are there? You could count every one of them. It's not going to make a huge difference. Let's face it, that's already giving you a clue. If you want more users, where do you have to go? You go to the places where there are 1 billion people living. You don't go to Eastern Europe. You could get every Slovenian. My wife is half Slovenian. The country has 3 million people in it. I wouldn't even notice you signing up every Slovenian in my total numbers. You have to go to India or China. China is always a tougher market. So guess where Netflix is looking to add users? It's India. But it comes with a catch. You know what the catch is? How much do you pay for Netflix? More than you did last year, right? I'm paying $19.99 because I have 4 people on my Netflix and I need 4 streams. You know how much an Indian pays for Netflix? In Netflix, you actually have a Netflix subscription that you can watch only on your smartphone, which a lot of Indians just do that. It's about $3 a month. An Indian user, and this is not an insult to Indian users, is worth about 1/5 a US user. So if that's the way you're growing, then I'm going to reassess your value because that user is not creating. And that's what, if you're looking at the Netflix story, those are the kinds of questions you're going to ask. And next time you have an earnings report, see if you can get on and watch what analysts are asking. They almost never ask questions about the story. They're so focused on mechanics, right? And I think that's part of the promise. That's why I think pricing can get very different from value. So earnings reports clearly can. Can macroeconomic news affect your story? It's kind of a silly question to ask. You're valuing a Russian company, right? When you started this class, if you value the company, would your story have been very different from today? Absolutely. Why? Because the world shifted under you. Of course, macroeconomic stories can. What about regulatory changes? Could they affect your story? Absolutely, right? In fact, Uber is a classic example. In my original story, I said Uber can keep doing what they're doing, treat the drivers as independent contractors. But it's not just regulatory changes. In California, where I live, there's a proposition that was put on the ballot that basically requires all companies to use independent contractors to treat them as employees. It's still being litigated. I think the proposition lost, but the courts actually ended up saying you have to. That could make a huge difference to my valuation. Could an earnings report from another company affect your story as a company? Let's say you're an AI company, right? Very young business. You don't know whether this will ever catch on. Another AI company reports that it's found a way to commercialize this and its revenues are growing. I know it's indirect, but sometimes success at another company, especially if it's a nascent business, can push up your value as well. This is true in electric cars, true in AI, it's true in ride sharing when it first started. So my bottom line is everything can change your story. You know what I'm setting you up for? You're going to tell me a story and send me a valuation next week. The Monday that follows, your story could be very different. Don't apologize for having to change stories. Don't fall in love with your own story to the point where you say, look, I don't care what the world is sending me. I just like this story and I'm going to keep telling that story. You've got to be willing to adapt, be adaptable. And one of the things we're going to talk about today is changing stories, modifying stories, adjusting stories as you go along. Finally, every valuation is a mix of story and numbers. But remember that corporate life cycle I showed you? You have young companies, you have mature companies, you have declining companies. Do you think the mix changes as you go through the life cycle? Any of you valuing young companies? Some of you might. Who are you valuing? Lucid Motors, right? Perfect example. How much do you learn by looking at the numbers of the company? Nothing much, right? It doesn't sell much. It's losing a ton of money. You might as well not have looked at the numbers in the first place. It's all story. The story can be big, it can be average, it can be small. The story is driving the entire valuation. In contrast, if you're valuing Coca-Cola, there's not much storytelling to tell. The story's been told. You're in chapter 33 of a 35 chapter book. What are you going to do? Create a twist in the last 2 chapters? If you value Coca-Cola, the mix shifts towards numbers. Now, do you see why analysts today are having because equity research analysts 40 years ago, most of the companies they valued were mature companies. Young companies didn't make it to the market. There were VCs investing in them. And Microsoft and Apple, when they went public, were already established businesses. That changed in the 1990s, and it's not going to change back. The Prom Equity Research Analyst says everything they do is attuned to mature companies, from the metrics they use, like price earnings ratios, to the way they think about valuation. They're having trouble with young companies because they're incapable or unwilling to tell stories. So with that lead in, let's go back to the notes and start with that, is it possible, plausible, probable question. Okay. Share. So remember my Uber story? Urban car service company. Local networking benefits. Doesn't own the cars, doesn't hire the drivers. In 2014, if you asked me, how do you justify the story? I could point to the facts on the ground. It was already in 150 cities. It was already getting new users in the Bay Area, which is where it has its deepest and longest roots. It had already doubled the size of the car service business. And at least until 2014, there was no pushback on the model, right? They still didn't own the cars. So in 2014, if you asked me to defend the story, it's clearly possible. It's happening already. It's plausible. I can show you examples like the Bay Area where the growth is happening, and it's probable. Could I have told a bigger story for Uber and Juno? Absolutely. I could have told a logistics story or a transportation story. But if I tell a bigger story, the onus is on me to convince you it's possible, and I have a much tougher task. Now, if you're a founder of a company and you go looking for venture capital, you want to tell a big story or a small story? What do you think will give you a bigger price? You would tell a really big story, right? But be careful, because when you overstretch, you have lots of weak spots. If you're going to tell a big story, you better think through that possible, plausible, probable, because otherwise the whole thing can implode on you. So I'm going to spend a little bit more time on this issue of possible, plausible, probable by giving you what I call a runaway story. What's a runaway story? Here are the ingredients. You got a storyteller who's charismatic. You really like the person. You want the person to succeed. The storyteller is talking about disrupting a business you've never liked. A lot of you, after you paid your tuition, if I came to you with a startup that says, look, we found a way to displace universities, you're all ready to listen to that story, right? You want this business to fail because you had to pay $200,000 for 4 years to get through this business. So I'm telling a story about disrupting a business you don't like. And you know what? I'm going to throw in some icing. I'm going to talk about how I'm going to make the world a better place. I'm going to solve world hunger. I'm going to make people healthier. When you listen to a story like this, you want the story to be true. You know what we do as human beings when we want something to be true? We stop asking questions. So let me give you an example. I'm going to tell you a story, and you tell me whether you want the story to be true. It's about a 19-year-old who drops out of Stanford. Who does that? What percentage of people applying to Stanford got in, like -3%? Unless you happen to be a rhythmic gymnast or something who came in through the side door, but that's a different issue altogether. Who gets into Stanford and drops out as a junior to start a new business? You're saying another tech geek starting another tech business. I'm going to make this interesting. This is a 19-year-old woman who's dropping out of Stanford to start a blood testing business. Do you guys like the existing blood testing business? You ever recently made a blood test with Quest Labs? First, you say, when is your earliest open day? 16 years from now. Unless you come in at 6 a.m., 6 weeks from now. So 6 a.m., you get up at 4 a.m., you get there at 6 a.m. And you wait for 2 hours. Why? Because they can't make you wait. 2 hours later, the door opens, a nurse comes out. She looks like Nurse Ratched from One Flew Over the Cuckoo's Nest. She said, come on in. You go and she has 2 buckets next to her. What are those for? Your blood. Why do you need so much blood? In case Dracula shows up, I guess. She extracts half your blood. Anemic, you crawl out of the room. You get back in your car, you drive back. You don't hear from the lab for like 6 weeks. And then you call the lab and say, I came in for a test. You tell me what the results are. We can't give you that information. Why not? Privacy. What? This is my blood. No, we'll send it to your doctor. Why don't you call your doctor and make an appointment, and the doctor will tell you. So you call the doctor when is your earliest appointment? 16 years from now. Unless you come in at 6 a.m. 6 weeks from now. So 12 weeks later, if you're lucky, you get your results. But don't celebrate, because there's one final insult coming down the pike 2 weeks later in an envelope in the mail. You know what it is? Your bill for $1,500. To do what? Extract 2 buckets of your blood and feed it to Dracula. Come on, you want this business to fail. And this woman, 19-year-old woman, has found a way to disrupt the business. She's going to take 2 drops of your blood. That sounds so much more humane. She's not going to put it in buckets. She's going to put it in nanotainers. That already sounds advanced. She's going to run 32 different tests on your blood. And 45 minutes later, she's going to email you the results. It's almost like she's in the 21st century. And the whole thing will cost less than $100. Oh, by the way, she's also going to give away these tests for free to people in Africa and Asia who cannot afford to have blood tests. She's going to make the world a healthier place. Come on, don't you want this story to be true? I didn't make up this story, right? This is, of course, a story of Elizabeth Holmes. And there she is in a black turtleneck. That should be in the first sign, right? The first definition of being authentic is don't try to be somebody else. You know who wore black turtlenecks, right? And this is the story of Theranos. And how did people buy it? Let's start with venture capitalists. Middle of 2019, Theranos was priced, I should have used the word priced, at $9 billion. And some of the biggest VCs in the world were supplying capital. So VCs had bought it. But it wasn't just VCs, because they can get sometimes food. The Cleveland Clinic, right? One of America's leading health entities, which, celebrating Theranos, said this is revolutionary. Walgreens, the second largest drugstore chain in the US after CVS, had said they were going to have a Theranos lab. So in the middle of 2015, if you asked me, what do you think about Theranos? My answer would have been, I don't know much about them, but look at the $9 billion value. Look at the fact that the Cleveland Clinic has put its imprint on it. Clearly, they must have come up with some revolutionary way of testing blood. But if you're an investor in a blood testing company, what's one question you'd like an answer to before you put in hundreds of millions of dollars? It's a blood test. Does the test work, right? I assume somebody would have asked this question, but I was wrong. Because in October of 2015, a Wall Street Journal reporter decides to ask this question. Does the blood test work? And in this case, the answer was actually in the public domain, because if you're a blood testing company, you got to get approved by the FDA for your test. He went to the FDA and said, Theranos is claiming that they can do 32 different tests on the blood with their equipment. How many of these tests have you approved them for? And the FDA said 1. So what about the other 31? The FDA said, look, we can't approve them because the tests are a little noisy. You know what a noisy blood test looks like? Trust me, you don't want one. Here's how it works. You go and you get a blood test, you get the results back, and the doctor says, you know what? You might be dying, or you might not. Don't worry about it, just go home. Okay? Not exactly a feature in a blood test. And when that report came out, the journal reporter actually called me before and says, do you know anything about this company? I said, I have no idea. And when he wrote the report, Theranos threatened to sue him. But over the next 6 months, the entire company kind of imploded. And know what happened to the $9 billion pricing? It went to zero. Along the way, it turned out that they'd been cooking the results, and there was a whole fraud issue that came up with it. But 6 months later, this company was worth nothing. Elizabeth Holmes had been banned from the blood testing business by the FDA for 2 years. She was being sued. In fact, the lawsuit just got completed. She was found guilty a few weeks ago. Her partner in crime, Sunny Balwani, is in court right now. But the question is, why did this happen? In October of 2015, I wrote about Theranos and had two questions. The first was, in hindsight, what's your reaction? Those stupid people. Why did they ask the question? So the first question I asked was, before you pass judgment on all those people not asking the right questions, I'm going to put you into a hypothetical scenario. In June of 2015, Elizabeth Holmes came to New York. She gave a talk in New York. And she was a celebrity by then. The self-made billionaire was not named one of the Kardashians, who actually had started a business. First, because usually you had these tech geeks, mostly men. So finally you had somebody who's under the age of 30, a woman who'd started a business with billions. People would bring their daughters along to listen to her speak. I said, June of 2015, let's say you'd gone to that meeting. You're surrounded by 12-year-old girls and their mothers and their fathers. And Elizabeth Holmes gets up there and she talks about how she's going to make the world a better place. And would you have had the courage to get up and ask the question, does your blood test work? You'd have felt like the guy who shot Bambi. Have you ever wondered about that guy? You ever watched the movie? Starts with Bambi falling over. I've always felt badly for the guy who shot Bambi. He must be going through psychotherapy because the whole story revolves around the tragedy that unfolds. It's easy looking back and saying, we should have asked the question. But the peer pressure you feel, especially when this social purpose gets thrown into the mix, right? You feel like a cad asking about mercenary things like, can you make money, when she's talking about saving the world. To me, one of the red flags in a story is when a founder talks so much about saving the world that they don't talk about the business. And the other question I asked was, what was the board of directors doing? So I took a look at the board and I could see what they were doing. I mean, take a look at this board. First, look at the ages. This is like a geriatric wing of a hospital, right? And look at the names. What is Henry Kissinger doing on the board of directors of a blood testing company? What's he saying? It's behind the Iron Curtain on this one. I mean, if I might be cynical, but if I were creating a board of directors for a company and never wanted to be asked questions, here's what I would do. I'd find a bunch of 80 to 90-year-olds, put them on the board. Then every time you have a board meeting, I'd make sure there were pillows in front of every chair, you fall asleep, a backup ambulance, but I'm never going to be asked a question. This is a runaway story. It happens more often than you realize. And Theranos will not be the first. It's definitely not going to be the last. I remember people coming out of Theranos saying, never again will we do something like that. Really? Because these are stories built around personalities, right? Elizabeth Holmes was the personality. And the problem is when you build this gigantic story with no anchoring in facts, there's going to be this risk that the story can unfold. And here's how it happens. First, the storyteller develops feet of clay. He or she does something that says, you know what? Maybe I should ask questions about this story. Second, you start looking at the story and say, there's nothing here that I can look at that's tangible. And then once the panic button gets hit, everybody runs for the exit doors. Remember WeWork? Incidentally, if you're interested in Theranos' story, there's the dropout on, is it on Netflix, I think, or Hulu, or wherever it is. Watch it, because it's actually, it's a good way to see how this process builds up and how people stop asking questions. WeWork, when it went public, lots of fanfare, right? The next big thing. Goldman priced it at about $100 billion. And I remember when Goldman put in that price, somebody, called me and they said, well, how do you think Goldman came up with that pricing? They do a DCF. I said, it's very easy to explain why they came up with the pricing. Why do you think Goldman put such a high pricing on WeWork? What did they base it on?
Their fees. They get more fees.
Well, I think the fees, but somebody's got to be willing to pay at the price, right? So he's got to have a basis. Who was the biggest VC? It was Softbank. When I say Softbank, what's the name that comes to mind? Master Son. And at that time, what did people think of Master Son? Visionary genius. So let's play the game, right? A visionary genius has put money in WeWork and priced it at 47 billion. That was the last pricing that Softbank gave. So you know what Goldman looked at, right? They looked at the 47 billion. They said, really smart guy paid 47 billion. That must mean the company's worth well more than that. Let's double the number and then reverse engineer. I would love to tell you that they started with an intrinsic valuation. No, they started with the 47 billion and built up. And there again, the story came apart in record time. 6 weeks between the prospectus coming out and this being the next big thing, to the company essentially being pulled off the market and people saying it's worth nothing. What triggered that collapse? We talk about, who's the charismatic storyteller there? A guy called Adam Newman, right? And if you read the history of WeWork, this is the first company in history that was born out of a TEDx talk. Adam Newman gave this talk like 12, 15 years ago about the importance of we rather than strange when you have the most narcissistic person in the face of the planet talking about the we. But then he got greedy and stupid. I remember reading the prospectus. A couple of things that jumped out at me. One was in the prospectus. They said that the company had paid Adam Newman like $600,000. You know why? He used the word we. He claimed that he invented the word and that because they were using the word. I don't know how you claim you invent the word we. But it's petty cash. It's stupid. It also turned out that some of the buildings that WeWork was leasing were owned by another company that Adam Newman owned. And they were so basically a conflict of interest. But here was, I think, the trigger to my becoming incredibly skeptical about the company. There was a section in the prospectus where they described the succession plan at WeWork. I've never seen this in a public company before. If you take a look, go back and look at the prospectus. In the prospectus, they said, if Adam Newman is incapacitated, usually in a public company, CEO is incapacitated, what happens? The board of directors gets together and picks a new CEO. Not in WeWork. They said Rebecca Newman, Adam Newman's wife, would be the one who suggests the success. What is this? A dynasty of some sort? But this is arrogance, right? Because what do they say? We're putting this all, we're rubbing your faces in it, and you're not going to react because we're special. This is what happens when arrogance meets arrogance, right? Master Son might be a brilliant man, but anybody who creates 300-year plans needs to have his head examined, because that's not a sign of humility. Say, no, God makes 300-year plans. You don't. Can you imagine Adam Newman and Master Son in the same room? Yeah, each person's arrogance. This is a classic example of a story kind of becoming unworn. So when you listen to a story and it sounds too good to be true, think of why you're not asking the questions, because you don't want the answer to dispel the story. So let's talk about another thing that can get you off the tracks. Right now, electric cars. Potentially huge market, right? Especially with gas at $5, $6, $7 a barrel. Electric cars that right now comprise less than 10%, maybe even less than 5% of the overall market. There are people telling stories. It could become 60% of all cars sold, 70%. So clearly this is going to be a huge market. You decide to start an electric car company. Why? Because it's a big market. And in fact, in any big market, that's what entrepreneurs do. They go towards a big market like a moth towards flame. She's saying, so what? What kind of people become entrepreneurs? Overconfident people or diffident people? What kind of personality do you need to be an entrepreneur? You have to be overconfident, right? Because you're saying, look, I'm going to be the one who builds the next big thing. And that's good, right? So you create this business and you go to VCs. Let me ask you the question about VCs. Overconfident people or diffident people? You think Mark Cuban is a shy person? Not exactly, right? In fact, the Shark Tanks, the reason we watch is they're not shy people. They're all overconfident. So you're saying, so what? So let's say you create a cluster. You've got an overconfident entrepreneur who attracts VCs who like his or her business model. They're overconfident. They pick the winner. So you've got a cluster of people going after a big market. Remember, because it's a big market, there are 100 clusters just like yours all across Silicon Valley, all building the next big cloud business, the next big EV business. And within each cluster, here's how the overconfidence plays out. When you estimate the value of your business, remember, you have a bunch of overconfident people around the table. What do? You overestimate revenues, you overestimate profits, you overestimate your chance of success, you overvalue a company. It's a feature, not a bug. You do this in each of the 100 companies. When I add up the valuation of the 100 companies, you know what I'm going to get, right? The collective value is going to be too high, not because you're being irrational, but because each group thinks it owns the world. My 40 years in the market, I've seen this play out multiple times. In the 80s, I started with the PC business. Remember, in the 80s, very few people had PCs. The business was viewed as a huge business. And you were right, it was a huge business, but very few companies actually succeeded in the business. Compaq and Dell might have been the exceptions. 1990s, with e-commerce, huge business. You were right? It became a huge business. But Amazon.com and perhaps two other players came out of the business as successes. Here I've taken the online advertising business. And here's what I did. I took the market cap of every online advertising company from Facebook, Google, Tencent, Alibaba, and I backed out from that what the expected revenues would need to be given the pricing 10 years out. You see, what does that tell me? If you take the expected revenues in 2025, this was about the total revenue I get is about 682 billion. That's how much revenue you built into the pricing of existing companies. You think, so what? The entire global advertising market in 2015, when I did this, was about 450 to 500 billion dollars. It's almost delusional because you're building in a market that's much bigger than the actual market, because with each company, you're telling a big macro story and you're assuming that you're going to be the winner of that story. So eventually there will be a correction and the price will drop and we'll all wring our hands and say, that was terrible, markets crash. You know what? It's a feature of markets. Over-optimists start businesses, they overestimate their values, there's a correction that happens. And I think it's a good thing. And when you talk about market bubbles, what do people say? That's terrible, we should stop market bubbles. Really? Do you want to live in a world run by actuaries? You'd never have a bubble, but we'd be still in caves, right? They're probably assessing this fire thing. We need a couple of thousand of years of research before we can take that risk. Every advance in humankind has come from people overreaching. The dot-com bust, did it change the way we live? When was the last time you walked into a physical travel agency? Most of you don't even know those things existed, right? There used to be one in every corner. You wanted to fly to Florida, you know what you had to do? You had to walk into the travel agency, sit across the table from a travel agent who had somehow this magical capacity to pull up flights and say there are places available. And you were so grateful you paid the person hundreds of dollars for this privilege. If you're still doing that, I feel sorry for you. But let's face it, the dot-com bust changed the way we live. So when you complain about markets overreacting and correcting, be careful what you wish for. Because I think in any healthy market, this is exactly what you'll expect to see anytime a new market pops up. One final piece of the story, and then we'll move on. now that you know that every Excel spreadsheet tells a story, I'd encourage you to pick up some equity research reports and start backing out the story that analysts are telling about the company. And then ask yourself, does the story make sense? So this is actually from almost 10 years ago, 2013. That's when I first valued Tesla, and I've valued every year since. I'd done a valuation of Tesla. I think I came up with, that time, $150 per share, which was actually very generous, given that they were selling less than 25,000 cars. But Tesla has had the good fortune or the bad fortune of having equity research analysts who just love the company. So this is actually from a major investment bank equity research report on Tesla. So I'll take you through this report, and each part of the story, I'm going to stop and ask, is that plausible? First, in this story, the analyst was projecting that the number of cars Tesla would sell go from 24,000 to 1.1 million over the next 15 years. Plausible? How many cars were sold last year globally? Does anybody know? About 80 million plus. So 1.1 million, hey, it's plausible. It'll take a lot of stretching, but no, I said, oh, fine. In fact, in my valuation, I projected about 1 million cars. So this analyst was pretty close to mine. His value was 4 times higher than mine. So I was looking for, why is this value higher? It clearly wasn't the number of cars being sold. I said, maybe he's assuming the company will be more profitable, more like a tech company in terms of its margins. So I took a look at the margins. And if you look at the margins over time do improve, but not to some astonishingly high level. In fact, the margins he was giving them are high-end automobile company margins. They're actually a little lower than my estimates. Now I'm befuddled. He's estimating about the same number of cars as I am, lower margins. Why is his value higher? Then I looked at how much he was reinvesting. He had 15 different line items, but usually in a spreadsheet, the easiest way to figure out what's being reinvested is take the difference between the after-tax income and the free cash flow. Everything else is kind of distraction, right? Because if you're reinvesting, those numbers will be different. And I added up the earnings for the next 15 years, the cash flow for the next 15 years, and he was reinvesting almost nothing. We have a problem. Do you see what the problem is? In the story, he's assuming that Tesla can go from selling 24,000 cars to 1.1 million cars. But in 2013, Tesla had one assembly plant in Fremont with a capacity of about 250,000 cars on a really, really good day, running at 100% capacity. Where's the other 850,000 cars going to come from? I actually called the equity research analyst. I'd run into him before. He was actually in an airport and taking a flight to California. I don't know. He might have been visiting a Tesla shrine or something. I don't know what he was going to do. And I said, you know what? I've been reading your equity research report and Tesla. It's very interesting, but I have some questions on your D.C.F, because that's what he called it in the report, a D.C.F. He said, I cannot answer those questions. I said, why not? He said, well, I don't actually work on the numbers. I have a team that does that. I said, okay, when will you be back? He said, next week. I said, can I call you with your team around you? He said, yeah, absolutely. I get ready to hang up the phone. He said, you're not planning to write about this on your blog or anything, right? No, I said, not for the moment, but a week from now, all bets are off. So I call him a week later. He's gathered himself with his team. 7 people work for him. So I asked the question, and the analyst, the lead analyst says, you know what? I don't work. I said, what do you do? He went on and on, but basically he was a schmoozer. He schmoozed with top management, schmoozed with experts. He talked to a lot of different people. I said, okay, you're a schmoozer. The second in command comes on and say, what do you do? I'm the secondary schmoozer. I go with this guy. If he said, then I can schmooze. Then the third guy said, what do you do? I'm the backup schmoozer. One of these 2 guys gets sick. I said, who in this group does something other than schmoozing? They said, it's that guy. There's a 23-year-old from Wharton that they'd hired the previous year. He's the guy who did the numbers. They throw him to the wolves. I feel really sorry for this kid. He gets up there and we go through line item by line item. And I said, what happened? Because he could say, I mean, it's once you put the things together, I mean, it's obvious. I said, what happened? He said, well, I took last year's CapEx and depreciation, and I just projected both to grow at the same rate, which is kind of the thing that training the street teaches you to do, right? Take line item, put this. The problem was in the most recent year, the capex was very close to depreciation. So we let them both grow at the same rate. You're basically building in the presumption that you're never building an assembly plant again. So I said, what do you plan to do? He said, we can't go public. It doesn't look good for us to say it slipped our mind to put in reinvestment. He said, do you have any suggestions? I said, I do, but I don't think you're going to like it. He said, give it to me anyway. I said, have you ever watched the movie Willy Wonka's Chocolate Factory? Have any of you guys seen this movie with Gene Wilder? If you haven't, it's a great movie, one of my favorites. I remember seeing that movie when I was much, much younger, and I came out of the movie with a singular question. Willy Wonka chocolates are all over the world, every store, but there's only one factory. The question I always had was, how the heck? It's a strange factory too, right? With the chocolate rivers running through it and strange creatures running through it. So how the heck do they have enough capacity in this factory to make all these chocolates? And if you've ever watched the movie, the answer is in the movie. There are these magical creatures called Oompa Loompas. If you've never seen them, get on Google, type Oompa Loompas. And here's what they do in the movie. They dance, and while they dance, chocolates come flying out of machines. No capacity restrictions. You can produce as much chocolate as you want. I said, here's what you need to do. Put out a news story that Elon Musk has fired all of his Fremont workers and replaced them with Oompa Loompas. He didn't take my suggestion, but I call these Oompa Loompa valuations. I see them all the time come out where people have these huge growth rates, high margins, but nothing being reinvested. But basically, that's what you're looking for, is you're not contesting the big assumptions, because then it becomes he said, she said. So if I said, look, you can't sell 1.1 million cars, I can't prove you wrong. If you don't, as long as you're not selling 500 million cars, which is clearly not plausible or possible, no, we can debate whether Tesla can sell 20 million cars or 5 million cars or 1 million cars. You're not going to win that argument because there is no winning. But you can point out the assumptions that the analyst is making that are internally inconsistent with what they're assuming about growth and margins. So now I'm ready to convert my story to numbers. So I'll remind you what my story for Uber was. Urban car service company, which will attract new people into the car service business, people like my son and my niece, with local networking benefits. It'll continue to do what it's done, not own the cars, not hire the drivers. So here's my job. I have to take each part of the story and make it into a number. So let's start. Urban car service company. You know where that played out? The total market I went after was the urban car service market. And in 2014, that market was about $100 billion. This is mostly taxi cabs in different parts of the world. I added them all up, $100 billion. That market had been growing at about 1 to 2% in the previous decade. I let it grow at 6%. Why? Because my son and my niece and people like them would be in this business. I gave Uber a 10% market share. That was huge relative to a typical cab service company, right? But I stopped at 10%. Why? Because in my story, remember, Uber can take New York, Lyft can take Chicago, there can be multiple winners. I can't give any company 30 or 40 or 50% market shares. And this is a business which has really no operating expense. It's an intermediary. So in steady state, after the bad stuff is done and after they've grown, I assume their margins can be sky high. The margins more similar to Facebook and other intermediary businesses, 40%. And because they don't own the cars, I'm going to assume that they can generate about $5 of revenues for every dollar of capital. The key when you do valuation is often developing perspective. When I say 5, you're saying, how do I know whether it's a high number or a low number? You know why I report the industry averages for pretty much every metric in your Excel spreadsheet? So you can check. The typical sales to capital ratio for a US company is about 2. I'm giving them $5 of revenues. I'm allowing them to be much more efficient. Why? Because they don't own the cars. I've got pretty much everything I need for my cash flows. To get a value though, I need a discount rate. How many sessions did we spend on discount rates? Too many, right? So remember the process. You get a beta, you get a risk premium, you get a weighted average, you do this. In the case of Uber, I ignored everything I told you about cost of capital. Because first, it's not, to me, it's not even on my top 10 list of numbers that are going to drive the valuation. I do know Uber is a risky business relative to other companies. So here's what I did. I have a histogram of cost of capital of all companies. I went to the 90th percentile. 12% is a cost of capital for a really risky business. I gave them the cost of capital and moved on. Just to check, I actually went through the full process, beta. I came up with, if I do the beta, cost of equity, equity risk premium, I get 12.73%. I'm sorry, 11.73%. You know what? I can live with 12%. But the company is still small. It's still money losing. There is a chance it won't make it, right? One big regulatory move. So that's 10% chance that they will not make it. Every part of my story has become a number. And if you think about where this plays out, once I have those numbers, the valuation kind of does itself, right? So if you look at this, it looks like I did a spreadsheet. But if you ask me, point to a number and say, why is that number what it is? I'm going to tell you a story. So if you tell me, why are my revenues 3.6 billion in year 10? It's because Uber is an urban car service company with local networking benefits. Why are my margins 40%? Because it's an intermediary company which doesn't hire the drivers. Why is my reinvestment so low? Because they don't own the cars. When you think about defending valuations, that's what I want you to think about. And I ask you, what's your revenue growth and why is it? You know the answer I never want to hear? It's because what they've grown at in the last 5 years. That's not a story. Anytime you use past growth as your only reason for using a growth rate for the future, you've lost the script. Now, in your story, you can say, well, the reason they grew at 20% for the last 5 years is this. I think it'll still apply for the next 5. I'm okay with that. So I play it through. And with my story, and I'm going to emphasize the word my, and the numbers that came out of the story, the value that I got for Uber was about $6 billion. Remember the Wall Street Journal story that got me interested in Uber? That venture capitalists had invested in Uber and they priced the company at 17 billion. I finished this valuation. I think it was 3:15 on a Friday afternoon. I posted on my blog. And about 15 minutes later, I get a call from a Wall Street Journal reporter. I don't know what she was doing, just waiting at a desk for the post to come through. She said, I just noticed you valued Uber. I said, thank you for noticing. She said, I also noticed you attached a value of 6 billion. I said, you're very observant. And then she said, you know that venture capitalists have valued the company at 17 billion, almost corrected her. Know what my correction would have been? Venture capitalists don't value companies, they price them. But she was a journalist. I cut her some slack. I said, yeah, I do know. She said, how do you explain the 17 billion? I said, I don't have to. I didn't pay it. I have never felt the urge to explain what other people pay. You know how much frustration that saved me in my life? Why are people paying 45,000 for Bitcoin? Ask somebody who paid the 45,000. Why are you asking me? Why are people paying thousands of dollars for bored monkeys? I have no idea. You know what I'm talking about, right? This bored monkey NFT. Ask somebody who pays the money. Why are you asking me? I don't have to go around explaining what other people pay. Then she said, are you telling me that the venture capitalists are wrong? I said, I'm telling you nothing of the sort. I'm saying with my story, I wouldn't invest in Uber. Maybe they have a much bigger story. Why don't you ask them? That's the way I think about stories and valuations. I have my story, my value, my decisions are run by my story. But I would never impose that on you because I'll give you the architecture. I want you to disagree with my story and make it yours. And that was the point of all the valuations of the week so far is I've told a story, I've come up with a value, I've come up with a decision, but that's not the right decision for you because you need to come up with your own story. You need to take ownership of the story. So at this point, you have a valuation and story. Let's face it, when you come up with a story for a company and evaluation, you kind of like the story and the valuation. Why? Because you came up with it. In fact, when you show it to other people, what do you want them to tell you? Amazing job, pat you on the back. I would have done it exactly the same way. And guess what? If you hang out with people who think just like you do, took the same classes you did, read the same books you do, that's exactly the kind of reaction you're going to get. And that's unfortunate. I think we live in a world where we're kind of thrown into people who think just like we do. You go to work for an investment bank, you're going to be surrounded with people who take classes just like yours, read the same stuff, agree that everything revolves around the cost of capital. You might debate bottom-up beta or top-down beta, but you're talking from the same script. You go to work for a venture capitalist, you hang around people who tell stories all day, and you think this is the way the world works. Here's my advice. When you value companies, hang out with people who don't think like you do. Show the valuation to people who don't think the same way you do. And don't get defensive. When they say that doesn't make sense, or what's a beta, don't say, well, you will learn after you've got a 2-year degree. And basically, your job is to take things you do every day and say, this is the intuitive explanation for what I'm trying to do. In the case of Uber, I got really lucky because my post got picked up in 4 very different places. After I posted, I get a call from 538.com. Have you seen the site? It's actually a site where Nate Silver created the site, basically applies statistics, techniques to pretty much everything, sports. And it's actually a fun site to read if you're a numbers geek. They said, our people are numbers geeks, we'd love to read this post. I said, go ahead, they take the whole post with the valuation posted there. The second place it got picked up was the Forbes blog. Who reads the Forbes blog? Probably 70-year-olds with flip phones, old time value investing type. So their agenda was, hey, we don't understand what's happening in Silicon Valley. Our investors would like a perspective on it. They'd like to. I said, go ahead. The third place it got picked up was TechCrunch. Have you heard of TechCrunch? It's this digital magazine for tech geeks, big Silicon Valley. They said, we'd like to pick this up because a lot of our tech geeks are interested in Uber. And the fourth place it got picked up was a site called the Ride Sharing Guy. It's still around. It's actually run by a guy called Harry Campbell, I think that's his name. And it's actually for Uber drivers and Lyft drivers. It basically talks about the ride-sharing business. And it's articles relating to their business model, how their lives are changing. Same post, 4 different sites, 4 very different sets of reactions. On the 538.com site, here's the kind of question I get. I noticed you used a 12% cost of capital. It was the 90th percentile. But I looked at your table and the 90th percentile is 11.87%. Why did you use 12%? This is how numbers geeks think. So I said, it's an open spreadsheet. Why don't you change the 12% to 11.87% and tell me what happens? 5 minutes later, I get an email saying nothing happened. I can see why you did that. Nothing learned there. Now, because you're nitpicking on 3rd decimal points, 2nd decimal points. The Forbes blog, they loved it. They said, this is the way. I spent no time on that. Nothing learned from people patting you on the back saying how amazing you are. The TechCrunch people absolutely hated me. Their reaction was, how dare you value one of ours with your D.C.F models? We don't do that in Silicon Valley. There are like 300 comments on the TechCrunch article. 100 were pure insults, some of which I didn't even get. One said, you DCF guy. That was a whole comment. I said, is that good? Is that bad? I said, okay, I'll take it forward. But some of them started with an insult and then gave me valuable information. So here's how it would go. You idiot. Let me tell you how ride sharing works and why Uber has an advantage. And they talked about how Uber collected data to do search. It was fascinating because I'm not a tech guy. I learned things about the ride sharing business I would never have learned if I'd stopped after the insult. But the most interesting things I learned about Uber came from the ridesharing.com site. The ride sharing guy said, because I heard from Uber drivers. I remember one email I got from an Uber driver in LA. He said, I read your valuation. I didn't understand some of the details, but I noticed that you assumed that Uber would keep 20% of the fare because that was the Uber pitch to investors. They keep 20% of the fare. He said, that's not true because here's what's happening in LA. He said, until 3 months ago, I used to drive for Lyft. Uber paid me $5,000 to switch. And now Lyft is offering me $7,500 to switch back. I feel like a free agent without a contract. But by the time this is all said and done, he said, I'd be surprised if they kept more than 7 or 8% of the fare. 5 years later, Uber admits that its contribution margin in the big cities It's actually between 7 and 8%. I almost told them, I knew that 5 years ago after talking to an Uber driver in LA. But to me, all of this feedback came in like 2 or 3 weeks. It all came to fruition. About 3 weeks later, when I was sitting in a Munich airport, waiting for a flight that had been delayed, I was checking my emails. And I see an email from a guy called Bill Gurley. You heard of Bill? Bill is actually a partner at Benchmark Capital, which is one of the first VC investors in Uber. In 2014, Bill was on the board of directors of Uber, and he was rumored to be the person closest to Travis Kalanick. Just an easy question. Does Bill Gurley know more about Uber than I do? Absolutely. So I opened the email, and here's how it begins. I read your blog post on Uber, and I did not like it. I said, okay, we got that out of the way. He said, I've written my own blog post to counter your blog post. It's very 21st century blog post to blog post warfare. And I've said some mean things about you in the post, and I just wanted to let you know. Sincerely, Bill. I like it when people say sincerely after they've said something like this. So I close the email. I have an hour and a half for my flight. Guess where I go next? I go to Bill's blog. It's called Above the Crowd. He's 6 feet 7 inches tall, so that's kind of above the crowds. Yeah. And there's the lead post. Demoderate misses by a mile. Yeah, I get it. No, ride sharing misses by a mile. And he took about every part of my story. He said, Uber is not a car service company. It's a logistics company. Notice how words have consequences, because what's he just done? He said, our business is not just car service. It could be moving. It could be delivery. He said, we're not just urban. We're going to be everywhere. He gave examples of suburban and rural services that Uber is going to offer. And then he said, you know what? I know that we dominate New York, but we're going to find a way to take the dominance and make it global by connecting with airlines and with credit card companies. Remember, every time it's true, you can use a different ride-sharing company in every city, but every time you get, let's say you go into the Middle East and you want to use Kareem or whatever, you have to enter your credit. So in a sense, they were drawing on the fact that people don't like to give their credit cards all over the world to car service companies. He said, we're going to find a way. Essentially, he was telling a story about how they were planning to make Uber into a global networking benefit company. I was fascinated. He thought I'd be pissed off. I said, this is a big story. I finished reading the story, still in Munich airport, and I emailed him and I said, Bill, big story. I love your story. Do you want me to put a number on your story? Because he didn't mention a single number through the storytelling. He said, what are you talking about? I said, I can convert your story into a valuation. He said, be my guest. So here's what I did. I took my valuation and changed 2 numbers. Remember, I had $100 billion total market, the urban car service market. If you treat that as the logistics market, it becomes 3 times larger, moving delivery, 300 billion. In my original valuation, I'd given them a 10% market share. Why? Because it's a local networking benefit story. He's telling a global networking benefit story. If he succeeds, in his story, there'll be only 3 or 4 winners across the world with big market share. So I gave Uber a 40% market share. The value I got was 53 billion. I sent it to him and he said, and asked him, do you like this more? And he said, a lot. I said, that makes sense. But then he said, you know what, this 20% is probably not long for the world. We're not going to be able to keep 20% of the fare. We're probably going to net out closer to 10%. I almost told him the Uber driver from LA already told me that. But I didn't change the 20% to 10%. The value I got was 28.7 billion. Your first reaction is, how can the same company be worth 6 billion, 29 billion, and 53 billion? It depends on how the story is framed. In fact, after I did this, I had an idea. In fact, I've applied this idea since to other companies. You've ever been to a Build-A-Bear store in a mall? It's got a creepy little place. You take your 8-year-old, they give them this piece of skin to stuff. They tell you don't have to buy anything. An hour later, you have the ugliest bear known to mankind, but your 8-year-old is really attached to the bear. And then they say, you can just leave the bear here, or you can pay $75. There's no way you're walking out of that store without paying the $75. Great business idea. So I decided to apply that to my Uber valuation. I said, let's build our own valuation of Uber where you, rather than disagreeing with my story and telling me what's wrong with it, why don't you pick your own story? And I said, I'll help you along. I'll give you the choices. What's the total market? Is it a car service company, a mobility company? What kind of growth do you see in the market? How many new people will come in? Will it be people just like my son and my niece, or is it going to go beyond that? What kind of networking effect do you expect to see? So each one is almost like a multiple choice. I said, what's your choice? And at the end of the post, I said, given your choices, this is what your value will be. And you can see the value ranges from less than $1 billion, if it's a pure car service company with no networking benefits, to more than 90 billion. I remember when I posted this, people said, this is why DCF is pointless, because you can get any number you want. I didn't see it that way. I basically said, when you get disagreements about stories, they're going to play out as very different valuations. Not all of these stories are equally plausible or probable. You can't all be right, right? So this is the essence of investing in young companies is, are you getting the story right? You're not going to make money on a young company because you get earnings per share next year, right? You're going to make money on young companies because you get the story right. So now, let's say you finished your story, you kept the feedback loop open, which is listening to people who disagree with you, made your story better. Now, things can change. Why? Earnings reports, macro events. Your story can break. I'll give you a couple of examples. You invest in a young pharma company with a blockbuster drug working its way through the pipeline. For diabetes, huge market, you attach a high value. You know what kind of story can make that value go to zero? Still working its way through the pipeline. It's being tested on people. You see a news story that says 3 people in the second stage develop serious side effects, and the FDA has ordered the company to pull the drug off. The value is going to very quickly collapse to zero. That's a story break. Russian companies, there's a potential for a story break, right? The story break can happen because the Russian government decides to nationalize the company. It's very real, a very real chance if you're looking at a Sberbank. There's no way the Russian government is letting Sberbank go bankrupt because that'll create runs on banks. But there's a very real chance they can decide to take the equity and say it's now a government-owned bank. That's a story break. A story shift is when your story stays the same, but the contours shift. Your growth can get a little higher, your margins can change. Between 2012 and 2019, I told pretty much the same story for Apple every year. Doesn't mean the value doesn't change. The value can change, but it's not going to change dramatically. My story was of the greatest cash machine in history, which is what Apple is, built around a single product, basically the iPhone. Living basically from iPhone to iPhone to iPhone. You see what happened in 2000? Now, along the way, they did introduce new products like the iWatch. None of that changed the value very much, because if you think about it, the Apple Watch cannot change the trajectory for the company because it's just too small a market. For a $3 trillion company, your next innovation has got to be immense. 3 years ago, though, for the first time, there was a business that could make a change, the Apple services business. It's an incredibly profitable business, and it's built on the platform, right? Basically, anybody with an Apple device interacts with the Apple services business. What way? Every time you go into the App Store and you buy an app, you might be buying it from some third-party software developer, but remember, Apple keeps a hefty slice of that for itself. It's an insanely profitable business. And it has a potential to be huge, right? Because you've got 1.4 billion people, I think, with Apple devices, all going through the system. That's a story change, something that makes you say, Moderna in 2019, even if you are optimistic about it, the story was small because it's mRNA vaccine, but how many people care about vaccines? In 2019, that was the reaction, right? Something you took for the flu every year. The polio vaccine, people took that 30 years ago. Nobody thought that the pharmaceutical business would ever have this vaccine moment. Well, COVID changed that. In fact, there are lots of stories that COVID changed in good ways and bad ways. Carnival Cruise Lines will never be worth what it was worth before COVID. I don't know about you, but I remember those first news stories about COVID. What do you see? This cruise ship sitting, 10 miles or 15 miles off Long Beach, and everybody trapped on the cruise ship. And my reaction was, I'm not stepping on that thing in this lifetime or the next one. Because it's like a petri dish. Carnival Cruise Lines, post-COVID, has a smaller story. There'll still be 75-year-olds who go to on cruise ships because they can eat as much as they want. Maybe that'll never go away. But the market is smaller. In contrast, Zoom in 2020, early 2020, was a successful company for business meetings. Potential market. Think of how much that story is expanded. So it'd be interesting to take a Peloton, a Zoom, a Carnival Cruise Lines, even a Tesla, and tell the story you'd have told in 2019 and tell the story in 2022. And ask yourself, how much has the story shifted? So it tells stories. Stories are at the heart of valuation. And it's a lot more fun than sitting there playing with numbers in a spreadsheet. Now, I've not valued a single company all the way through, and I'm at least going to start the process rolling, because starting through next session, going through the next two, I'm actually going to go through full-fledged valuations of companies. So we're going to do a bunch of companies, and in every one of these companies, you're going to see equity risk premiums. To save myself the time of explaining why is the premium changing over time, I'm going to give away the game. Some of my companies go back 20 years. I'm going to show you my Amazon valuation in January 2001, when Amazon was a tiny money-losing company. And I'll give you an equity. And the equity risk premiums on all of my valuations reflect the implied equity risk premiums at that time. So you're wondering, why does it go from 4% in 2007 to 6% in 2009? Hey, you got the 2008 crisis in the middle, the implied premium went up. So the reason my equity risk premiums change over time is the valuation to spread out over time. So if I get a chance to value a company next month, you might see a 6% equity risk premium or a 5.5%. That's what the implied premium becomes next month. So with that structure, I'm also going to tell you how each valuation is going to present. With each valuation, I'm going to tell you a story about the company. I'm going to come up with a model that reflects that story and the inputs that do it, and we're going to come up with the value. And with each one, I'm going to focus on one aspect of the valuation, so I'm not repeating the same thing over and over again. So let's start easy. I'm going to start with a really simple company to value. You guys all familiar with Con Ed? If you live in New York, you should be, because you get a bill from them every month. Maybe your landlord gets it. But Con Ed is the regulated utility that serves New York. Regulated utilities have two features. One is that they're monopolies, usually for the most part. It's changing in some parts of the country. Normally, as a monopoly, what's the fun stuff? You get to charge higher prices, but regulated utilities don't have pricing power because a commission determines how much they can. So the nice thing about regulated utilities is because they're so constrained, you don't have to worry about other businesses they can get into or fast growth. So this is a mature company. So I wanted to ask, what kind of valuation model can I get away with? And remember, my advice is start simple. So the first question I asked is this company behaving like a mature company? So one thing I checked is this paying out dividends like a mature company. Mature companies don't pay out 5% or 10% or no dividends. They pay out 60, 70, 80%. This company is paying out 73% of its earnings as dividends. First estimate. Second, I said, what kind of growth rate can you expect in the company? 73% payout ratio means your retention ratio is 27%. And remember that shortcut we used to get to growth in earnings per share? You take the retention ratio times return equity. The growth rate I got was 2.1%, which is a growth rate you can maintain forever. How do we know? Well, the risk-free rate is 4%. So basically, this is well below the risk-free rate. You got a mature company in terms of how it pays dividends and its growth rate. And it's actually one of the few companies, it's in a sector, which is one of the, I think the only sector that I know of, where companies pay out roughly their free cash flow equity dividends. And in fact, in Con Ed, I actually checked it out. I computed the free cash flow equity and dividends, and over the last 5 or 10 years, they've been paying out almost all of their free cash flow equity. You see where I'm going, right? It's growing like a mature company. It's paying out all of its free cash flow equity and dividends. I used a stable growth dividend discount model. What does that mean? To value the company, I get the expected dividends next year. So this year's dividends grow out to 2.1%. That's it. That's my entire valuation. Your reaction is, I wish I'd bought picked a regulated utility to value for my project. It's true. Your life would be far simpler, but what exactly are you going to learn from this? The value per share that I got was $42.30, which was slightly higher than my price, which means the stock is mildly, very mildly undervalued. But don't get too excited, because here's one way to check to see how much buffer you have. If I take my valuation and just change the growth rate, if I lower the growth rate, I'm using 2.1, I trade 2.05, 2. There is a growth rate at which my value will converge on the price. It's actually a very useful statistic to compute. In my case, was like 2.03% growth. You're saying, what does that tell me? I'm assuming 2.1% growth. The market is assuming 2.03%. It would be crazy of me to say that difference is large enough. I'm going to go out and buy Cornell. This stock is close to fair value. In fact, I'm going to leave you with the final page to think about. If you've ever read an equity research report, one of the things analysts always give you is a target price. When you do traditional discounted cash flow valuation, you get a value per share today. You're saying, let's suppose you go to work as an equity research analyst and your managing director says, don't give me this DCF value today. We need a target price. I don't know what happened there, but hopefully nobody got killed. No. But basically, here's what I want you to think about before we start class next session. I want you to take the discounted cash flow valuation we got and see if you can convert it into a target price. How do you take a DCF and make it a target price? Because that's something you need to learn how to do if you ever end up in equity research. So I will leave you with that, and we'll start with that next session. Go ahead.
So as we continue going through this, I'm starting to realize that you're saying change the story, change the story.